Hey, welcome to Option Brew Market Shot. Today with Mark Phillips of Harvested Financial. Hello, Mark. How are you?
Hey, good afternoon, Lex. How are you doing?
Good. You're looking very dapper today, I might say. Very, professional with the sweater and shirt. I like it.
I think it's the white shirt that gives it away. It's like, who wears white shirt these days?
No, I love it. I never wear collared shirts anymore. It's working from home. I'm stuck in the sweater mode. So
okay, that's comfortable. See, I spent so many years that was all I was wearing, and now it's all I got. So I have to wear them.
You look great. Awesome. Okay, so today we're going to talk. Mark's got an interesting trade today, I think, for folks. It's actually a trade that he described to me pre-show, and I don't know the name of this one. I didn't know the name of this one. So, Mark, I'm going to let you go from here. Describe this trade. Let's hear about this one. This one's a good one.
Yeah, absolutely. So this is a slingshot trade. So one of the more esoteric option strategies out there. And I like to think of it as a flavor on a collar. So it's a modification of your standard collar that would go around, a stock position that you might have.
Okay.
So the standard collar, of course, being selling the call to buy the put.
Okay.
And you sell the upside call to take those funds that you receive, collect the premium selling the call, and use those funds to buy the put as protection. So that collars your exposure to the stock. You have the short call on the upside that offsets your gains, and you have the long put on the downside that's going to offset your losses. So, you can put a collar at 1%, 5%, but the collar, offsets and manages that stock position that you have.
Got it. Okay. One of the more famous collars in history. And again, I didn't talk to you about this, so I want to say it anyway. So Mark Cuban, did you know this?
Yes.
He got Yahoo stock when he sold his company. And that was the thing that he suggested to, I think it was Goldman at the time, whoever did that deal, that he get a collar on Yahoo stock, which was the most brilliant idea ever. He demanded it. And because at that time, Yahoo stock was really high. And I think, as time went on and things happened way back then, his collar saved him, truly saved him. Yeah.
Worth over $1 billion, I want to say, right? Like, locked in a pretty fat premium on that.
Yeah, he locked in $1.5 billion or thereabouts. Yeah, it was amazing. So these are powerful tools is the point of that story. Yeah.
Incredibly powerful tools. When you have a concentrated stock position like that, whether it's, an acquisition of a company, even if you're just an employee getting, RSUs, the GSUs, like, all these stock option incentives, that concentrates a lot of your risk in the, not only do you have like the market risk, but you have the specific company risk that's both your job risk and your financial risk. So
sure. No, that's
in one basket.
Yeah. Okay. So that's the straight collar, right? That's what Cuban did, and that's what we just described. Now the slingshot concept, a little different, right? So you're adding another component here. Let's hear about that a little.
Exactly. So the slingshot, the name sort of implies that you want to stay exposed to that big swing up. So you want to, like, to the extent that the stock really runs up, what the slingshot allows you to do is stay exposed to that. And the way it does that is instead of just selling a call, you would sell a call spread against your stock position. So you sell an upside call spread and you still use those proceeds to buy the downside put. And so in selling the call spread, that kind of has two features. One, the call that you buy back on the upside. So, in a short call spread, you're going to be short the near the money call, and you're going to be long the further out of the money call. That long call, what that gives you is it caps your short risk so that if the stock really rockets up, you start participating again. So you have a defined zone over which you're short that call spread where you're neutral. But stock really gasses up and you're going to start participating again on the upside.
Right. And so if in that example, if it slingshots up, as per the name, the two calls are going to offset each other. Your short's going to be exercised in the money if you hold it this long to expiration. Your long, if it's in the money as well, gets exercised, right? They net out against each other. You're still left with your original stock position. Bingo. And we have a long put still that we're dealing with that probably expired worthless if you didn't roll it out. So maybe we can talk about that a little bit when we get on the screen share.
Ooh, the roll is a very interesting component.
Oh, I know. I knew you were thinking. I could tell.
You know where I'm going.
All right, good.
But yeah, let's pull up an example here because of course, as you sort of mentioned there, that the because you have a call spread on, you're actually going to end up collecting a little bit less money on that as a credit. So your offset might be a little bit different here than a straight collar, because a straight collar we usually get sort of equidistant exposure, 1% up to protect 1% down.
Sure.
But I'm going to pull this up in Apple. Great name, very liquid markets. Plenty of people that have concentrated stock in Apple too. But a good example here. So I'm actually going to pull up the March expiration. So, we're looking a little over 2 months out here. And I'm just going to go right with the at the money call spread. So I'm going to sell the 130 call.
Yep.
Stock's trading about 129.5 right now. So
sure.
Sell the 130 call, and then I'm going to buy the 140 call back. Okay.
Let me ask a question real quick. So just for the viewers, is there any magic to that $10 spread versus a $5 one versus a 2.5 one? Is there any thought there for you when you set these up, why you choose $10 for this?
It's a really interesting question. And I think in many ways, like one of the things that goes on in my mind is I like a strategy that has a really intuitive explanation to it.
Okay.
And so, as I was thinking about this, like one really easy way to think about this is you give up the first $10 of upside. So, that's something I can understand. The first $10 in Apple, okay, I'm willing to give that away. But then I'm protected by about 10% on the downside, actually. So this is a pretty intuitive, the numbers work out well here, I guess, because I'm going to use the funds from this, so at 350, and then I'm going to go to pay about, about that 370 level on the downside here.
Okay.
So this is almost an exactly neutral trade.
Got it. And meaning, we won't talk about the Greeks on it, but meaning that the credit that you generate from that call spread is paying for that put, right?
Exactly.
So those numbers are about equal. So the net is around zero-ish, give or take.
Right. That's exactly a very good point. And, thinking about that with a collar, typically it's the type of thing that you want to do for, as close to even as possible. You're kind of, it's inherently got a trade-off baked into it already. So, you don't necessarily always want to establish that for a debit or credit.
Perfect. Okay, good. Looks great.
But so this is what this would look like just in March right here. And, we got 10% downside protection. Apple goes down by more than 10%. You're totally covered. You're receiving that coverage by exchanging the first $10 of upside. Okay. So yeah, really interesting kind of graph here because, like you mentioned, all the way at the bottom, you're totally protected down there. Below that, it's that 117 level, that 117 half put that you're long. Put starts kicking in, and your P&L flatlines. Right. You're relatively neutral in this middle area, but above 140, which is the call that you're long again, in that call spread, you're going to start participating again. Just like stock, and this is just like that stock chart. Up and to the right. Yep.
Good. Yeah. So this gives you, a defined downside, right? And the reason we're losing money here, right, to the downside is because we're long stock. Let's not forget that, right? So that's going to cost us some money when we go down to that. I think you mentioned 10%. I think it was the number you used. So that's a bit of a loss down that way, but it's defined. It's capped out. So it's important to know that that's what this whole collar and slingshot idea does. Is right where Mark in the box there to the left of that box where it says minus 1215. That's your number. That's all. That's it. That's the end of the story for your losses on this particular spread, right? And then to your right there where you measure, so right here, that's your call spread doing. It's a 1-to-1 now, meaning that the longs and off shorts have already set each other off. You've lost on it, but your stock position is gaining dollars in P&L to make that start looking wonderful. Is that right?
Exactly. So, you want to be able to participate. You'd want to use this when you want to be able to participate in that kind of big upside move. You don't want to give away all your upside, right? But you're willing to give up a little because you want some security with this whole position. So, that's where, like you said, that red zone is, you have to give up some of that loss. You give up that first 10%, but then you're done.
Right. Okay. That's awesome. I love it. This is a great graph. The slingshot, huh?
The slingshot. No, there is a new option strategy under every stone you kick over.
I'm going to have a question about this slingshot, but I think you're going to hit it anyway. So go ahead.
Well, I think another interesting way to play the slingshot is to do it over time.
Mm-hmm.
So, one of the things you can think about too is doing this across different months, and using the near-term options to sell the call spreads while keeping that longer dated put.
Great.
So one of the examples I'll pull up here is I'm going to look out to April. So we're going to go out, almost a full quarter here.
Okay.
And I'm going to look towards the April 130 put. So I'm buying the at the money put right now. This might be a scenario, you want really lock it in and really, secure the value of these holdings. So we're going to buy the at the money put.
Okay.
So now what I'm trying to think about is, all right, I spent $10 on this put. How can I finance that? What do I have to give up to finance this? And if I'm going to look towards Feb in the beginning, so remember I said April is 90 days out, Feb's about 35 days. I'm going to have 3 monthly intervals between now and April that I can sell call spreads against this put to finance it.
Okay.
So I'm going to look for something that I can collect a little over $3. So if I collect, $3.50 every month between now and April on that call spread, I've funded my 10 and change dollar, put.
Correct.
Completely protects me.
Perfect. Yep. Understood.
So where am I going to go for those $3? In April, I can look at selling, maybe I'll sell right here, collect $6 on that. And that's actually that same 130, 140 level here, because it is shorter dated than the March one we looked at. But that's going to offset that by about $3 for your April trade.
Right. So the original trade here is in your boxes. It's about $7 to do this whole thing right now. And don't forget, the reason it's 7 is because we have that long put out in April. So that was that $10 put that Mark's referring to. So we've reduced it by about that $3, almost exactly, right? So that's the 7. And then we're going to do this a couple more times in terms of rolls. Is that correct?
Exactly. So like you say, we're spending $7 today to put on this trade, but we're expecting to collect over 2 more trade intervals to about 350 call spread, collect $3.50 on call spreads that will sell when March is 30 days out. And
Got
we'll
it.
sell again when April is 30 days out. So we get 3 $3.50 call spreads to offset that $10.50 put.
Okay. Now, if someone wanted to do even be a little more, I don't know if it's more aggressive or not, but what if someone wanted to start with the current weekly and just do this every week for a while? And maybe it's only $1 and they do it, 10 times or $2 and they do it 5 times, something like that. Is that something that they could construct as well? So there's a lot of expirations before that April, correct? With these weeklies?
Yeah, with I don't know if I can do that math totally on the fly, how many weeks it is between now and April expiration, but it's got to be like 13 or something like that.
Yeah. So right. So that's $1-ish, a little less than $1 per roll if you can get it. Is that right?
So you'd really only have to give up, maybe a $2 call spread here,
okay.
Like 75 cents on that, that's going to go a long way to offsetting that put expense.
Okay. Yeah. So that's kind of a little more of a personal preference. Do you want to keep rolling this and pay attention to that? Or do you want to get a bigger chunk fewer times, I think, right?
Definitely.
Yeah.
And, the shorter dated options are going to have a lot more premium in them.
Yep.
But you are going to see some more choppiness there potentially.
Okay.
So by constantly trading week over week, you could see a little bit more choppiness there. So that is always one of those sort of balancing act between, do I go for the longer dated stuff or do I, use more shorter dated stuff?
Sure.
It comes down to a lot of risk tolerance and, like you say, time management.
Okay. Yeah. That makes sense. So there's two mechanisms to do that here, a little bit more active versus not so active. What happens when we get to the April expiration? We make that last roll into that month, right? We still love the stock, love the position, it's protected. We do one more into that April month. As that April month comes to expiration, we have to make a decision. We're going to roll that whole package out again, right? And start a new cycle of 3 more kind of spreads with a well-placed put way out into the future, right?
Exactly. And that gives an opportunity to sort of reset the level too, potentially. So
sure.
That's another consideration is that, you are only protected below 130. By buying that put in April, if stock rallies up really hard in the beginning of this, kind of period, Sure, you can keep selling the call spreads higher up, but your protection level is further out. So, if you potentially did that against, maybe a March or even a Feb item, you'd be able to roll your protection level up more as the stock tended to increase. So that's another kind of balancing consideration when you think about where to anchor your, protective put strike.
Got it. Good point. Okay, that's awesome. Well, this is a great spread. The slingshot. You got me on this one. This is good. I love it.
Slingshot is, a great kind of flavor on the collar, and it sounds like a boring stock management type strategy, but there's a lot of really interesting nuance you can get here, and really depending on your risk tolerance, how much you're willing to collect, or you can do a lot of pretty clever things with that.
That's great. That's a great strategy. So, all right. Well, thanks, Mark. Awesome.